our Monday special Midcap Mania with Nigel D'Souza. Nigel, what stock is this?
Well, Anuj, today we're going to talk about a stock known as Monte Carlo Fashions. Remember, I was just looking at the stock, and in the last 10 days or last 1 month, the stock has done very, very well. Now, if you just take a look at it from the demonetization lows as well, the stock has had a big run, really, if you just take a look at it in the last 1 year. But you take a look at the IPO price. Well, the IPO price was at around 645, so it's still significantly off that IPO price that we saw earlier. Valuations, not very, very expensive. It trades at around 2 times EV upon sales because the market capitalization is there at around 1,200 crores. And in fact, they have no debt. So that's one part. And the second factor is, in fact, that it's trading at around 20 times its normalized EPS or normalized profit of around 60 crores. Last few years hasn't been great. Last year in particular wasn't great in terms of revenues. They were hit. Margins as well were very disappointing. You pull up the profit number as well. That came down to around 42 crores. They normally do around 60 crores in terms of a net profit. Why was last year so bad? Because they really were hit by demonetization, and importantly, inventory levels as well were higher. Why were they hit by demonetization? Because Q3 is the most important quarter for them. They get more than 55 to around 60% of their revenues in that single quarter, and that in fact should come up for you on the screen. That explains why they were hit so badly. If you just take a look at their mix, they've been turning around their revenue mix as well. So before they were depending a lot on woolens. Woolens, as of now, contributes around 58%. But now, in fact, they're looking at cottons as well. So this is their revenue mix in FY17. And if you take a look at FY13, you'll see that, in fact, now the focus is more on kids as well as some home furnishing. They also, diversifying in terms of their geographic reach. Before, they were focusing only on the north. Now they're indicating that, in fact, they're going to be looking at the west as well as the south. And in fact, that has been improving as well. Pull up FY13, you'll see that the proportion at that point of time was indeed very, very small. Now, that's really the strategy going ahead. In terms of channel diversification, well, multi-brand outlets, that's where their focus is. Why is their focus really on multi-brand outlets? Because, in fact, the inventory risk is very, very low there. There's no discount sharing in terms of MBOs. That's multi-brand outlets. And importantly, if you just take a look at it, that's limited discount as well going ahead. What have they done right? Because the numbers didn't look very good in terms of financials. Last year, they did an EPS of around 20 rupees. They paid 10 rupees of dividend. That's one thing good. Second thing, they've been paying off their debt slowly. And their debt from around 0.4 times debt to equity, now it's come down to around 0.1 times. So that's something, in fact, that looks good. And it's a net cash company. They have close to around 85 crores in terms of net cash in their books, which is close to around 7% of their market capitalization. What's the big fear, though? Inventory days. That's something that I don't really like. It's around 130 days approximately. That's the time from when they put the item into the shop till the time it actually gets sold. And also the net working capital days. That's at around 152 days. That, in fact, is the time they start making the product to ultimately the sales happen. Promoter holding at around 64.5%. They've done minor creeping in the last 1 year or so, and a whole host of big funds. So we're talking about the monsoons. Well, when winter comes, this one could be in focus. Back to you.
Okay, Nigel, thanks a lot for that. Standard disclaimer, these are not recommendations, but just some interesting tidbits that Nigel has quoted. Mr. Sultan,